well, I can do, the silver is running out dance. I don't really, it doesn't bother me. If they run out of contracts tomorrow and it goes to 200, well, yeah, I'll sell. Yeah, because that will be a short-term thing. The long-term price is different. Mm-hmm. And that long-term price, if you want to really know what it is, just look at a sort of moving average and look at the trend on the moving average. And if you go back, say, I don't know, 100 days, 200 days, 3 years, don't care. It will be on that trajectory, and that trajectory will keep on grinding up. So, the true story is somewhere between where it's going to be in 3 months and a year. Okay. And I'm riding that picture, and that picture to me is $80 to $100.
Clem Chambers. The silver market is moving into a phase where long-term fundamentals matter far more than short bursts of speculation or temporary market disturbances. He emphasizes that while outages or trading anomalies capture headlines, they do not change the underlying reality. Silver cannot be replaced quickly. Mining development timelines stretch over many years, and above-ground inventories are steadily diminishing. This slow structural tightening forms a durable upward trend that overshadows the short-term noise, positioning silver on a trajectory defined by scarcity rather than sentiment. Chambers stresses that the strongest driver going forward is the combined force of retail demand and industrial consumption, rather than sovereign accumulation. Governments continue to prioritize gold for strategic mobility, while silver is increasingly absorbed by high-technology industries that require exceptional conductivity and heat management. With global AI infrastructure expanding at an unprecedented rate, data centers, advanced cooling systems, circuitry, and energy hardware are consuming large volumes of silver alongside copper, rare earth, and other critical materials. In his view, this shift is transforming these metals from everyday commodities into strategic industrial inputs essential to maintaining technological competitiveness. In Chambers' professional outlook, the market is steadily moving toward a supply-demand imbalance that will redefine silver's long-term value. As industries scale up their need for high-performance materials and mining output struggles to keep pace, he sees the metal moving toward a sustained price range of $80 to $100. Massive investment in AI infrastructure, expanding energy requirements, and the global race for computational power are anchoring this upward pressure. Under these conditions, silver is positioned to transition into a materially higher valuation framework, driven by enduring structural forces rather than temporary market events. Now, we present the clips from Clem's interview with Kitco News. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
You see, that's all noise. Now, if it suddenly, there was this big squeeze, and tomorrow it went to 95, I'd probably sell, yeah? But if it doesn't go to 95 tomorrow, or the week after, or the week after that, or the month after, or by Christmas, or by next Christmas, when it gets to 95, I'll probably sell. And I really, really don't care whether it's today, tomorrow, next week, next month, next year, or the year after that. That'll be fine by me to hang around for 18 months, but I think it'll be faster. So, if you're chasing the daily move, you're a day trader. Yeah. That's a great way to lose all your money. If you're chasing the move in the next 3 months, well, you're positional, and that's quite a sweet spot for these sort of things. If you're strategic, like I am, you don't really care. I won't be sweating until we get in the 80s. And then I'll be going, what about tomorrow? Because it'll be approaching that, 100. Yeah. That I see is not fate, but likely. Yeah, okay. It's likely going to 100. When it gets there, I'll make a decision on whether I think it's going to go to 200 or not, which it probably won't. So, it's like, if you're going to be an investor, that's the best way to be. You can't help watch it every day because it's fun, right? But all this short-term stuff, it's like back in the day with Bunk Hunt. Oh, it's a corner, it's going to go through the roof. Oh, they changed the rules. Oh, it didn't go through the roof. Yeah. The point is that silver is a strategic metal. There's not enough of it. And one way to look at it is this. Gold, 3,200 tons a year is mined. Silver, 25,000 tons. That's 8 to 1. Yeah. That's all you really need to know. And if all of a sudden there's more demand for it than there is supply, it will go to some sort of balance. Yeah. And, is that demand going to be maintained for the long term? I believe it will. I think silver is going to be very, very important in what's up for next. So there will be the use case for silver is such that its price will be significantly higher than today. So although I can do, the silver is running out dance, I don't really, it doesn't bother me. If they run out of contracts tomorrow and it goes to 200, well, yeah, I'll sell. Yeah, because that will be a short-term thing. The long-term price is different. Mm-hmm. And that long-term price, if you want to really know what it is, just look at a sort of moving average and look at the trend on the moving average. And if you go back, say, 100 days, 200 days, 3 years, don't care. It will be on that trajectory, and that trajectory will keep on grinding up. So, the true story is somewhere between where it's going to be in 3 months and a year. Okay. And I'm riding that picture, and that picture to me is $80 to $100. I would say if I was really thinking that was coming, which it probably is, platinum and palladium is good for that because that is heavy and you can pack a lot of that into a sub, but not silver. However, silver is a strategic metal in two places. One, at retail. And when retail are seeing gold doing what it's doing, and it's going to carry on doing that, they start to think about, I think I need to load up on that. And of course, gold is, for $50, you get a tiny piece, whereas silver, you get a nice shiny lump. And $100 is still a nice shiny lump for $100. $100 don't get you much shiny these days. Mm-hmm. Yeah. So with retail going with the flow, getting a bit of FOMO, that is the juggernaut. That is the unstoppable horde. And if they get a flavor for silver, and they are getting a flavor for silver, they got a flavor for gold. Now they're getting a flavor for silver. Well, that's a juggernaut that will drive things to $100. Now, behind that is a strategic need for silver in AI. And any hard commodity is going to stop being a commodity. It's going to become a luxury. And I've been saying this, it only dawned to me. I was at a gold show, the Gold Messe show in Frankfurt, with a lot of people that have been following gold and all that stuff for a long, long time. And they're talking about commodities. And that word was just buzzing in my brain. I thought, these aren't going to be commodities. They're just going to get sucked up by the AI maelstrom. And they're going to have to be luxuries. Yeah. And silver is one of them, because silver is the best conductor of heat. And AI is going to be all about getting rid of heat, because you've got to pump so much energy in. Now, if you think about an AI service center and they're building them, they're going to cover the world with these blooming things. You have all this stuff in a shed, and energy comes in and information comes out, and the information comes out on a tiny little piece of string, tiny little optic fiber. And all those resources are going into that big metal box full of raw materials, full of gold, silver, rare earths, cobalt, you name it, lithium, fancy cooling stuff. Yeah. And that is the future. All those wonderful commodities, which we think of as commodities, because you get loads of them at a low price, that world's going away. And, that's going to be actually turned into great things. But, it's all going to get sucked into these server farms. And you just have to see what they're building out there. Was it $1.5 trillion going into that? 1,500 billion. Million. Yeah. It's just huge sums. And mainly it's going into the sort of raw materials that make the sort of things that NVIDIA make, and all the cooling and all the racks and all the cabling and all the transformers. It's really down there at the base of the value chain. Yeah. And it's going to take it all, and it's going to take all the energy. And, what does that do to prices? Well, if you think about commodities, if you think about your iPhone, you think about how much raw materials is in that $900 or $1,400 piece of kit. It's not that much. It may be $150 of stuff, which is, a good model if you're melting it back down again. But if it actually went from $150 to $500, how much will that change the picture for the price of that iPhone? Not hugely. So there's plenty of room for these foundational items to go up a long way without actually affecting the day-to-day price of things. But that is coming. And the big one that is really coming is this stuff's going to take all the energy, absolutely all the energy. And that's why they're building nuclear power stations. And just think about nuclear power stations. Why the devil are they building nuclear power stations when they were actually Satan incarnate only a couple of years ago? Well, because all the energy that you could possibly imagine is going to be used on this stuff.
In recent market developments, concerns over tightening physical supply have intensified across global precious metal hubs, with analysts pointing to deepening stress beneath the surface. Against this backdrop, Vince Lanci has emphasized that silver's current behavior reflects more than routine volatility. It reflects a system struggling to meet physical obligations. He explains that major banks continue rolling futures contracts not because it is a strategic choice, but because actual metal in London and other centers is becoming increasingly difficult to source. China's early capture of upstream flows, limited lease availability, and steady COMEX withdrawals all signal a thinning inventory base. According to Lanci, institutions are effectively delaying deliveries to avoid confronting the larger financial shock that would follow if they were forced to settle without metal in hand. Vince Lanci also notes that this environment has deepened the financialization of the silver market, pushing obligations out, cash settling them, or shifting them to new delivery months to prevent stress from surfacing. He points out that declining open interest in one contract and rising open interest in the next are a clear sign that banks are buying time. Lease rates remaining flat do not indicate comfort. They reflect a shortage so acute that traditional lending mechanisms cannot function. As COMEX deliveries continue to drain available stock, Lanci argues that the price movements seen in recent weeks are not solutions, but temporary pauses, masking a structural imbalance that grows sharper with each roll and each deferred delivery.
The silver squeeze has yet to begin, really. The global silver market is tightening into a slow-motion short squeeze as physical supply vanishes, demand accelerates, and financial engineering replaces metal delivery, real metal delivery. Now, that sentence there, it sounds like something like, yeah, we knew that, right? But understand that when an industry or a person is under stress, they do what they've done before, just more. And so I don't really see, at least on the surface, to the extent that I can, the shorts in silver doing anything but delaying it more. And I'll say a little bit more about that. Silver's squeeze, in our opinion, hasn't started yet, but the setup is in place. So physical supply is vanishing. These are things we all know, but put them all together. Physical supply in London is vanishing, right? While industrial demand, ETFs, and BRICS buying accelerate. Bullion banks are still rolling futures to defer delivery, turning a metal shortage into a balance sheet financialization potential problem, right? I mean, there's some big deliveries being taken, that's the word, but they're not all being taken. Some of them are being rolled. Look at how the open interest is rolling. Drops in one month and goes up in another. They're kicking the can down the road. I'm not saying that's a bad thing. Well, it is a bad thing. But I'm saying that's, when your back's against the wall, you do what you've done to survive. And I think having been in that situation, I think they're just doing what they do because there's nothing else they can do. I'll give you an example. When you look at what's going on around silver, China pre-sold upstream supply. Silver cannot be leased like gold. Okay, Eric Young and I have discussed that, but that's something Eric really focused on a couple months ago. And that's, what? Central banks have gold to lease to people who need it. They don't have silver above ground. So I remember what Eric says, that's really good insight. So anyway, COMEX deliveries keep pulling metal flow from an already depleted pool, right? Yesterday's price action, I should say, reflects financial stalling, not real capitulation. The real event comes when funding fails or a counterparty breaks. Until then, stress builds quietly beneath the surface, not so quietly lately, and the clock keeps ticking towards a physical repricing. Look, the point being is, if I'm a short of serious financial means, I have a lot of access to capital and serious physical market connections, and I can't get my physical anymore. Well, I have two choices. I could default and say I don't have the silver, and I'm not going to do that because it would jeopardize my firm, which is much bigger than my little silver division. Or I could do what I've been doing, and that's double down. That's the martingale, right? All right, roll it. Hope they don't take delivery. If they take delivery, give them what they can and roll the rest. Keep deferring it. In a sense, they're financializing the physical by rolling the shorts. And it's not just rolling the shorts. When you get into the physical delivery moments, someone will say, I want delivery. And if you're the short that has to make delivery, because that's what happens, well, then you call them up if you can't make delivery. And you say, listen, I can't make it. Can you delay for 30 days? And they say, sure. They say sure, they say no. If they say sure, then you guys do an OTC trade. You roll from, let's say, Novi to Dece in futures, and you see the open interest change the next day without a real trade going on. And you say, okay, what happened there? Well, what happened there is the short negotiated with the one who wanted delivery and said, look, if you wait 30 days, I'll have it for you. It's a check is in the mail type of thing. And you keep doing that, but you have to incentivize them on that. It's maybe you give them a free toaster. Who knows? But the point is, it's you cajole, you prod, you get people to roll. Now, with the hopes that as time goes on, because they're buying time, the problem corrects itself and then someone changes their mind. It's like, I want to buy gold, it's going up, and then it goes down. And then you say, I'm not going to buy it, it's cheaper. That's the same mentality, right? So they're testing to see how real the demand is. It's really significant. That's what you do when your back's against the wall. You say, dude, would you mind rolling it? And the guy's going to say, I'll roll 2/3 of it, and that just keeps happening and happening and happening. And the problem comes if the bank gets to slowly cover his shorts over the next 3 or 4 months, but he covers them with some idiot fund that gets short. Oh, I'm bearish, right? Well, and then the market goes up, and then delivery gets taken again, and the one who wants to take delivery isn't a big bank. Isn't taking it from a big bank. They're taking it from a small hedge fund, and then you have a counterparty blow up. Boom, right? So just to bring it all back to English, they're rolling and deferring delivery with the hopes that either the metal will come up or the delivery will go away. They won't need to do it, right? And in doing that, they are taking physical risk and fully financializing it. In a sense, it's a cash settlement, right? You keep cash settling until the metal's truly needed. And that's where we are now. We're not even, it's not a short squeeze yet. And here's why I feel that way. The lease rates, which spiked last time, everybody was all over that. Bloomberg, Reuters, the lease rates are up, the lease rates are up. Lease rates aren't up this time. Okay. And the lease rates aren't up this time because there is no metal to be leased. So you're just not going to lease it. We're not going to ask. Anyway, I think we're just getting started, and that means you could have dollar swings either way. So
looking ahead, the broader trajectory suggests the silver market is approaching a phase in which genuine physical scarcity will dominate pricing far more than leveraged futures activity. Industrial consumption is accelerating across every major sector tied to global modernization, high-density electronics, specialized energy systems, advanced weapon guidance, medical technology, electric vehicles, and the rapidly scaling infrastructure behind AI and data centers. Each of these industries requires silver not as a luxury input, but as a core functional material with no effective substitute. At the same time, mining output has remained stagnant. New projects face long development timelines, and above-ground inventories are being drained faster than they can be replaced. As these forces converge, silver is positioned to enter a multi-year valuation shift in which its price reflects not short-term trading behavior, but the structural realities of rising strategic demand, constrained global supply chains, and the increasing importance of metals that underpin a fully electrified and digitally driven world. Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.